Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Well, this headline definitely caught our attention late yesterday. VW, Volkswagen, taking another swing in its long struggle to catch up with Tesla. So plowing some $5 billion into a tie-up with the U.S. company's closest would-be rival. We are talking about Rivian Automotive. The news, Tim, sent shares of Rivian soaring. It happens to be one of my gainers today. VW ADRs, though, we have seen them put a little bit of a lower trade in the session. So what does it mean for the EV race and for some of VW's original EV plans? And does Tesla kind of need to be looking over its shoulder?
That's the question that we posed to a Bloomberg TV co-host of Bloomberg Technology, Ed Ludlow, who joins us in our San Francisco bureau. It was certainly a whoa moment for us, Ed, when this crossed yesterday after the market closed. $5 billion from Volkswagen to Rivian. What was your first reaction when you saw this?
Well, to be honest with you, I was zooming around the San Francisco Bay on an electric boat. And I'm serious. Go check out my, and as you guys know, I covered Rivian so closely for so many years now. And without betraying confidence, I actually went to visit RJ Scaringe a couple of weeks ago. And he's either got a great poker face or this is one of the best kept secrets. But it was a big surprise. And what I'd say in summary, it's an excellent deal for Rivian that Rivian really needed in so many ways. And it's probably evidence that VW, who has really struggled with software in particular, had to do something to kind of get themselves moving forward in this new era of vehicles.
Ed, I'm curious. It's so funny. Over the weekend, I was actually chatting with a friend who
I thought you were going to say over the weekend you were on an electric boat.
No, I wasn't on an electric boat, but I was with a friend who drove up in his Rivian truck, and I was asking him about it, and he said, you know, the thing I'm concerned about is whether this car gets bricked if this company goes away. How badly did Rivian need this money?
You absolutely nailed it. I took a phone call last night from, let's say, somebody really close to Rivian and RJ Scaringe. And in the first instance, when you think about the big stock reaction, it's up to $5 billion of cash injection from VW over a 3-year period. Whether that materializes or not, we don't know, but it definitely shores up the balance sheet. There's been a lot of concern about the rate of cash burn. But also, it's really interesting the point you've raised. It's about the demand side of the equation for Rivian. The person that I spoke to was like, I think this is really good for people that are on the sidelines or on the fence about buying a Rivian. It gives some kind of legitimacy and support to the idea that if you were to buy a Rivian, they'll still be around in 5 years' time to service it because of VW's reputation and its scale. And it's a great partner to have.
Is that a legit concern? I think about the early days of Tesla. Weren't we kind of having a similar conversation?
I think so. I mean, Rivian, you know, it gets bundled in with the likes of Fisker, which is, I think, filed for bankruptcy now. I just was on vacation, so I might have missed that.
It did. You were on vacation,
also,
but it did file for bankruptcy.
You know, Lucid has never built any vehicles, really, but Rivian, to its credit, has, and it's deliberately constrained its own supply this year. They had some difficulty in getting those customers. But what I'm trying to tell you is, like, it's a legit company.
Yeah.
It's just basically the most bearish on the street look at their cash pile and look at their market cap and say, well, hold on, look at the rate you're burning cash. You've got more cash on your balance sheet than your market cap. The market's basically telling Rivian, we don't really assign you any value or any long-term value, at least, in what we think you're going to do. And I think this deal changes that narrative. Sure.
Ed, speaking of legit companies, Volkswagen, certainly a legit company. So what does VW get out of this partnership?
Yeah. Well, if you don't mind, let's go through the structure of the deal. So basically, VW takes an equity investment in Rivian. In the first instance, it's $1 billion this year in the form of an unsecured convertible note. And then they pledge to invest $1 billion next year and then the year after 2026. And in return, they get access to technology. You know, what I've heard is that VW's Cariad unit, that was the unit working on VW's software to take on Tesla's kind of software platforms, has had major issues. Like, they've really struggled to get their head around it. So Rivian's really good at software. They've got great talent. They regularly update over the air. The OS is good. VW gets access to that. And then there's this JV where they're going to build some EVs together in the back half of this decade. Sounds a bit wishy-washy to me, like these things often are. But yeah, it's just access to technology that Rivian does have. Rivian's not very good at building at scale yet, sure, but what they've designed is pretty good. I think Tim probably would have heard that from his friend who visited.
Yeah, he likes it a lot, and it certainly sort of fits the bill of everything he wants a truck to do, and he's happy with range and what he does with it. I am wondering, though, another question about VW, Ed, is what does it say about VW's ambitions for EVs, and it's certainly its lineup of EVs right now? I mean, they've got the ID4, but what does it say about VW?
It's cool because when I was in Europe and you're on the streets in Spain, I was in Spain, you see all these cars that you just don't know exist in America, and some of them are electric. So Volkswagen has other EVs in Europe, ID3 being one of them. But Volkswagen is going through what every other legacy OEM or automaker is going through, which is they've realized they can't go full send into electrification. They have this kind of bridge period where hybrids are a really big part of the strategy, and they'll have to continue to sell affordable combustion engine cars to bridge the gap, because right now that's what the consumer still wants. So this Rivian deal is a great example of a hedge. VW looking to a partnership with a pure play and saying, well, okay, this kind of gets us in the right ballpark technologically speaking. We're going to build vehicles together in the future. And in the meantime, we can carry on with what we were doing, which is building many gas engine cars and some of our own EVs.
All right. So what does this mean? Like, how should those who are listening and watching us right now think about what's going on in the global EV race? I mean, should we expect more partnerships between players, some more consolidation? How should we be thinking? And should Tesla be worried?
I think so. Don't know that Tesla should be worried.
Okay.
I mean, there's a really well-read story on the Bloomberg today, which you will have seen, that Tesla is the best-selling seller of
Don't
of
give it all
EVs in
away.
America.
We're going to do it right after you.
Okay, sorry. I'll leave it. But the point is like Tesla's still number one. Rivian aspires to be like Tesla, but it's nowhere near right now. But the VW Rivian JV is just another example of something that's happening over and over. Think about all of the Tesla deals that have been done for the charging network with legacy OEMs, GM and Ford being the most prominent examples. You see collaboration in other markets, where GM, as an example, or Ford, as an example, work with local partners in China as a market. Like, it's not a new thing. Tesla has talked about outsourcing full self-driving. And if there's one lesson we're kind of learning here, and I'm sorry to repeat myself, Volkswagen's not very good at software. So, like, this is where those legacy names are at right now, and partnerships are the new norm. Real quick, I don't know how we have time, but I just want to make one really clear point, and I was really strong with the editors about this yesterday. Rivian's got a horrible track record in JVs. It ditched Ford, and Ford ditched them. Its JV with Mercedes lasted just 3 months. So if you were Volkswagen, you'd be going, well, if I'm dating Rivian right now, they're not really good at long-term relationships.
Kind of love that.
Maybe they're not good at long-term relationships until they are, right? That's all it takes when you're dating.
Yeah.
Right?
Which means the belle of the ball, Tesla, might not be so worried, which you have set us up for so lovely for our next story. We're going to leave it there. Ed Ludlow, thank you so much. And of course, co-host of Bloomberg Technology on Bloomberg Television. We're going to stay in the EV space to the company that VW is kind of revving to go up after, and that is Tesla.
Yeah, it's a story about how Tesla is on the verge of losing a key bragging right that it's held for the past 6 years, outselling all EV competitors in the U.S. combined. For more, we've got in our Bloomberg studio, Bloomberg News senior reporter Tom Randall. Tom, good to see you. We knew this day would come. Tesla knew this day would come. This isn't a race that we didn't know the end would be, so far out for. Why is this so significant, though?
Well, I would argue that it's a little bit more than just a bragging right? Like, what they're doing by outselling everybody else in the market combined, having that kind of market majority is a rare and extremely valuable thing in the United States. And the other companies that have it, think about it. It's NVIDIA and AI chips, Apple with the iPhone, Google and internet search, Amazon with books. And each of those companies has been able to turn that market majority into $1 trillion valuation. Actually, all of those are $2 trillion valuations now. And Tesla was able to do the same thing, and it was worth over $1 trillion in 2021, 2022. And that's when its market majority was its biggest. And since then, the rest of the industry has been kind of closing the gap. It hasn't been able to maintain that kind of distance that those other companies have, and its market valuation has suffered because of it. And that having that market majority gives you a lot of different things. It, not only economies of scale, first and foremost, for an EV maker, but it also gives you political power. It gives you brand recognition. It gives you the first choice in any kind of supplier arrangements. We might be seeing the end of that era where things were a little bit easier for Tesla because of their position in the market.
Well, speaking of that political power, I wonder if some of that, what's happened? I mean, the obvious thing is there's more competition, right? We were just talking about it with Ed Ludlow, but I feel like every day we're talking about the EV space and whether there's more names. We talk about Chinese competition, maybe ultimately being also another player. But I do think about the politicization or the political conversations that Elon is not shy to do sometimes, and I'm wondering if some of that has played against him.
I mean, I think that's certainly part of it. That's and when I talk to people, both consumers and analysts, that's always part of the conversation. But it's a very difficult thing to quantify, right? Is how much does political, do politics influence buyer choices? But there are plenty of other things that are going on right now, and some of them on Tesla's side and some of them the rest of the market. And I think from Tesla's side, the biggest thing is that they just don't have new vehicles coming out at a time when everybody else is flooding the market in every single segment with electric vehicles. Tesla still gets 95% of its sales from two vehicles, the Model 3 and the Model Y. And the Model Y is, both of those are multiple years old. And, we have the Cybertruck now this year. It's slowly ramping. Right now it sells for $120,000 for this kind of early buyer purchase price. We don't know what it's going to sell like.
And I think it's fair to say that there might not be universal demand for a vehicle of that nature.
I think that's fair to say. I don't think we will know until we see what the final price is, right? He originally said it was going to sell for $40,000, that all of this savings was going to come from the way they were building it and stuff. And, if it was $40,000, I think you would have plenty of buyers, but I don't think that that's going to happen. We don't know.
The piece that we're talking about, the piece that you wrote, has a great chart in here that shows to what extent other U.S. vehicle makers, or rather other vehicle makers around the world, have surged in recent years, and what Tesla has done over the last year in terms of their vehicles. So who's sort of nipping at Tesla's heels right now?
I'm actually working on a story right now, so I won't completely give it away, but really kind of following that kind of race for second place in the United States. But I will say, it's pretty obvious who's kind of in the lead right now, which is Hyundai, Kia, and General Motors. I think those two are kind of standouts right now. If you look in just raw numbers over the last 12 months, Ford is definitely there too, but they have the same problem that Tesla has, which is they don't have new vehicles coming.
But they also have the demand problem.
Yeah.
And that's the problem that Ford has. I mean, there was a time when we would be talking to you or a BI analyst about Ford, and they couldn't make these Mach-E's and F-150 Lightnings fast enough. Now they can't sell them.
Yeah, I mean, although if you look at their numbers, they're still up like 40% year over year every month. But month after month, 80% actually.
Which is higher, but not necessarily where they thought they would be when they were making these.
And they've had to cut prices considerably in order to get there, and that's what's hurting them, and that's why they pulled back a lot of their investments.
If we, Elizabeth, if you can bring up the chart that shows, Tesla versus the rest of the world. So Tesla, for those on radio, obviously on television and YouTube, you can see this, but the white line has been Tesla, which has shown how dominant they've been in the industry. Below it, an orange line where everybody else was lagging Tesla by a wide margin. Now those two lines have merged essentially and met, if you will. Having said that, Tom, as the EV market grows, it doesn't mean Tesla, maybe they don't have as much share, but they're still a pretty viable business, right? And they still dominate the EV industry in the US.
They are absolutely dominant both in the United States and internationally. They sell more than 5 times as many vehicles as Hyundai, which is their closest competitor, nipping at them. But if you look at their trajectories, Hyundai is growing 50% year over year, and Tesla's actually...
It's the growth, right?
What about when we take into account all vehicles that are sold? Where does Tesla fall? So not including just EVs, but if you're comparing Tesla to a Ford or a VW or a Hyundai, who's selling? How much more are those companies selling than Tesla?
I'm sorry.
If we're talking about just EVs, it makes sense. We're doing apples and apples. But what if we were actually to make the apples and oranges comparison? Because people are still buying ICE cars.
Right.
I know people are going from EVs back to internal combustion cars for various reasons.
Well, in that case, then yes, Tesla is still just a small percentage of the U.S. market, and globally, like compared to Toyota sales, it's just a tiny fraction.
Yeah.
So it still has a long way to go that way. But they are different supply chains. There are different strengths, as we heard with Volkswagen and Rivian. When you have somebody like Volkswagen having to come to somebody like Rivian for help with software, that tells you that this is a different industry that we're in right now. And I think if you look at what Hyundai's doing, they have a full lineup,
Right.
from small car to large luxury 3-row vehicles. They've got it all. So does GM now. They're all coming out this year, but there's considerable demand for those vehicles, and they are ready to compete.
Great stuff. Great deep dive. Tom Randall, he's Bloomberg News senior reporter.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, Carnival out with earnings before the market opened yesterday. Stock was up about 9% on that news. It's up it's up 20% since June 14th. It's up 8 days in a row. The most recent optimism, though, coming as Carnival raised its full-year earnings outlook after strong demand for cruises helped it post a surprise profit last quarter. So let's get to it, and let's get to our interview on this Wednesday. For more on the outlook of the company and the industry overall, great to have back with us Josh Weinstein. He is President, CEO, and Chief Climate Officer over at Carnival, joining us from their headquarters in Miami. Josh, great to have you back with us. How are you?
Yeah, I'm doing well. Thanks for having me.
Well, it's good to have you here. It feels like you guys are firing on all cylinders. Your booking position, you're booked for next year already ahead of 2024 levels on occupancy and ticket prices. Give us more color around that. Like, as I said, it feels like you're firing on all cylinders.
Yeah, I think that we are, and it's really gratifying to see for the whole team. We just wrapped up our second quarter, and we were able to report record revenues, record yield, record per diems, record EBITDA, and record operating income. So that was a really big quarter for us. And the best news about it is that was the actual results. But from a bookings momentum standpoint, as you were saying, the bookings that we took in just in the second quarter actually set another record. And it was the record for the most bookings we ever took for the forward year out. So in this case, 2025. So as stellar as 2024 is looking when it comes to the demand profile and the booking trends, 2025 is already shaping up to be even better.
So you can pack up your bags, go home for a year. No, I'm just kidding. Hey, talk to us
Maybe
about
go on a year-long cruise.
Go on a year-long cruise. Hey, how broad-based is it? Break it down for us. You guys have several brands, and I know about a year ago you did a restructuring when it comes to those brands, but how broad-based is it in terms of customer segment and geography?
Yeah, the great thing is it is exactly that. It is broad-based. So we're seeing strength on both our North American brands and our European brands. To put that into perspective, the past quarter, the second quarter, because we're a portfolio of world-class brands, brands are coming in and out of different economic cycles, different geopolitical issues. And whereas a couple of years ago, we were talking about our European brands just taking a little while longer to catch up than our North American brands coming out of our pause. In the second quarter of this year, their yields were up over 20% year over year, and so we're getting this momentum across the Atlantic and from all segments, be it contemporary, be it premium, be it luxury. We're really seeing strength in what we have to offer, which candidly it isn't surprising to us because first of all, as we've talked about before, we are an incredible value. So even though we've been successful in really pushing on that demand and getting our pricing up, we are still an incredible value versus alternatives. And not only are we an incredible value when you look at our alternatives, the service levels that we provide are unmatched. And they're just as good as they were from before the pandemic, which is not something that a lot of hospitality outfits can say.
I'm wondering about the trends that you're seeing when it comes to onboard spending, excursions. Are there any signs of lower spending once consumers are on board, or are there any signs of weakness that you're seeing anywhere, Josh?
Excuse me, no, not particularly. In the second quarter, our onboards were up about 4% per diems year over year, and as you know, last year was up incredibly over the pre-pandemic period. So The trends that we look at to understand the strength of our consumer, we've got the results, we've got the onboard spending in real time, we've got the bookings, and all of those metrics for us are telling us that our consumers are incredibly strong. We've got incredibly strong brands that really resonate with the segments that we're going after, and people are absolutely still willing to spend on experiences. And that is exactly what we offer. Great experiences, we create memories and happiness for a lifetime.
Hey, Josh, one of the numbers that struck me too is your total customer deposits reached an all-time high of $8.3 billion. That surpassed the previous record by over $1 billion, $1.1 billion to be exact. Does all of that turn into revenue that shows up ultimately on the balance sheet? In other words, are there cancellations that can happen? What do you see around that?
Yeah, there are cancellations that can happen, but the vast majority of that is going to come through ultimately in revenues. So that's a bit of a forward indicator of how we're doing. And that increase is really a combination of increased pricing, us elongating the booking curve, so taking bookings even farther out than we had even just a year ago. And, we're doing a better job of bundling our offerings so that people can spend in advance of the cruise, not just for the ticket price, but certain onboard experiences. So it's a combination of those things that we've been very focused on that are attributing to that increase in customer.
Well, that's something we've talked about, right? All of the bundling that happens before they even step on a ship, and that ultimately can lead to more spending. Because that thinking of, I've already paid for everything, right? And you get on ship and you're like, wait, I can still spend. Like, that really works.
It does really work. It does really work. I mean, it's a good amount of time that goes between the initial purchase impulse and then getting on board. So having what we refer to as a second wallet available is real. And actually, folks who buy something of onboard spending before they get on the ship, they spend more on board than those who don't do anything in advance. So it's a very strong opportunity for us.
Okay, Josh, I'm wondering about pricing pressures that you may be facing at the company. You're talking about consumers who are out there spending. That's certainly strong. What about where you have pressure? Food prices, labor costs, fuel costs. What are you seeing on that front?
Yeah, the good news is there's been the deceleration of inflation. We don't see disinflation, but we certainly see a deceleration, which is encouraging. I think if you look at our P&L, you'll see on the crew and labor side, our teams are doing a real good job of trying to be mindful of the P&L and certainly pay a good living to people, but doing so efficiently. The biggest thing that we see as a change from pre-pandemic times to now is probably that combination of two of the things that you said, food and fuel. Those are inherently more expensive, and we're doing our best because those are always going to be inputs into our business. We are laser focused on reducing consumption, because no matter what the price is, if we use less, we will be better off. And so I'll give you two examples. On the food side, we are looking every which way we can to cut the amount of food we put on board, cut consumption, to be more mindful of the fact that we've got a lot of food waste in any given year. We've actually, because we put this focus onto it, we've been able to cut our food waste by over 40% per person per day versus where we were before the pandemic. And that is because we are giving so much thought to reducing the whole consumption cycle while still giving guests everything they want, but just being more thoughtful about how we do that. And on the fuel side, not only is it good for the environment, it's good for the bottom line. And even though we are over 30% bigger today than we were in 2011, we actually consume 10% less absolute fuel than we did back in 2011. We emit over 10% less absolute terms greenhouse gas emissions than we did back in 2011. So by being laser focused on that, not only can we be good, world citizens, we can make a huge impact on our bottom line.
Hey, speaking of being laser focused, you guys still have, I think roughly, I was looking at the Bloomberg, maybe around $30 billion of debt still on your balance sheet. I think $4.1 billion maturing by year end. How might the bookings and the outperformance there maybe power help with debt reduction? Like, what's your plans on that?
Yeah, absolutely. That is, when it comes to our capital structure, priority one, 2, and 3 is reducing that debt balance. We've actually reduced it by $8 billion versus our peak, which is great. I predict we probably got another $1 billion or so to go as we get through the remainder of this year. That should get us to leverage metrics heading towards about 4.5 turns, which is a big inroads versus where we were just a couple of years ago. Now, what we see as a plan going forward is, in addition to the fact that our increased EBITDA and better business is going to help our metrics and help the shape of our balance sheet, we have intentionally reduced our supply growth, our pipeline of new builds in the medium term. And so we're looking at a profile with only one new build coming in 2025, none in 26, and then one in each of 27 and 28. What that does is it will allow us to take billions of dollars of free cash flow each year for the next several years to pay down debt. And that's exactly where we're focused. You know, I was a treasurer for 10 years, and we were an A- company. I know the power of having a fortress balance sheet.
Hey, Josh, I don't want to belabor the point here, but we're hearing over and over again from people not like you that they're starting to see some cracks form in the consumer. We're seeing some price wars happening in fast food right now. For example, are you seeing weakness anywhere in your business or anywhere in the consumers that you deal with?
You know, at a general level, no, we're not. We see the demand profile is incredibly high, and I attribute that not just to the value gap, not just that we're getting better at what we're doing, but if you think about it, you just put yourself in the minds of a consumer. If they are stretched, if they are looking to figure out how do I make my vacation dollar go further, that is playing into what we have to offer because we are bottom line, we're a cheaper alternative than lots of other things that they can choose to do. And they're seeing the value of that. They have friends, they have family who have taken holidays with us, and they can champion us on our behalf.
Josh, so appreciate it. Have a great summer. Josh Weinstein, he's president and CEO of Carnival Corporation, joining us there from their headquarters in Miami.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
He is the wealthiest person in the world, depending on the day, but I mean, come on. He has spent some 4 decades building up the House of Arnault and the clothes and accessories that signify status among the global elite. You know brands that include, of course, Louis Vuitton, Christian Dior, Bulgari. I'm going to hope I'm saying it right.
You wrote it, you read it.
Celine, Fendi, Tiffany, and more. He's not done. Let's get to the new monthly issue of Bloomberg Businessweek. We welcome in the editor, Brad Stone, author of Amazon Unbound and the Everything Store. He, too, along with Bloomberg's Angelina Rasquet, wrote the cover story that is now available on newsstands, on the Bloomberg, and at Bloomberg.com/Businessweek. Brad, we have been looking forward to this new redesign of Bloomberg Businessweek. But for those who maybe aren't in the know yet, remind us about the redesign from the ground up.
Yeah, sure, Carol. So Businessweek is now a monthly magazine, right? That's perhaps unusual, but it's a 100-year-old brand that stands for examining the biggest companies and names in business, and we continue the tradition every day on Bloomberg.com and now in the monthly magazine. This is a magazine that I think will surprise a lot of people. It looks different, it feels different, it's thicker, and our mission is to put a critical, significant force in business or tech or politics or economics on the cover every single month. And as you say, this month it's Bernard Arnault. I did not know a lot about him before starting this journey, but as you say, one of the wealthiest people in the world, $210 billion, has fallen a bit since the French parliamentary elections.
Right.
I think he'll be just fine. But he's now the third wealthiest person in the world, and I think not very well understood.
Well, it's interesting that you mention elections because politics actually plays a big part in his origin story. So just sort of get into that a little bit.
It's interesting. He grew up in the north of France. His father ran their family's manufacturing business, had a small real estate component. He, highly accomplished, went to the best engineering school in France, joined the family business, got his father to reorient towards real estate, moved to the U.S. after the left won the French elections in I think the late 70s or early 80s. You're testing my knowledge here of French history, and really didn't do so well in the U.S., but woke up to the possibility of these small little luxury houses, often family owned, Christian Dior, Louis Vuitton, that weren't really being run as businesses, but were being more run as kind of cultural artifacts. And he was very opportunistic. He bought the company that owned Christian Dior out of bankruptcy in the early 80s and has been on an acquisition tear ever since, buying companies sometimes through sort of leveraged buyout means and assembling this huge empire.
Great story, though. I mean, Tim and I have been talking about this offline about Christian Dior and a New York cab driver. Can you tell us a little bit about like that helped him kind of think about,
well,
right?
He tells the story, and it has moved into mythology or legend.
Lore,
but
right?
Apparently when he was a college student in the U.S., he asked a cab driver at JFK, do you know the name of the French president? And the cab driver did not know, but knew the name Christian Dior. And that, he says, sort of awakened him to the cultural resonance of these brands. And when we think about names like Louis Vuitton, Bulgari, Hennessy, Tiffany, which they recently acquired, it is interesting. I mean, these are brands that have done extraordinarily well in China. In a way that the Chinese luxury brands have never been able to do. And he's tapped into something that I think is true about this lifestyle and European tradition.
Well, I want to go to China now, because when he went to China in the early 90s, he tells a story of what he saw there. It's a far cry from anyone who's been to one of the mega cities in China in this day and age and seen one of the businesses that the company owns, perhaps on the famous street in Shanghai where all the luxury brands are. What did he see in China in the early 90s that gave him an indication that this is going to be a killer market?
Right. Well, we asked him about that. And in fact, I think the answer to that precise question was there was nothing. He was very skeptical. He said that one of his memories was that everybody was wearing Mao suits. And, if you've got a luxury business and a fashion business, you're probably like, is this the right place for me? And also at the time, the Western brands were confined to hotels, tourist hotels. So they were operating a Louis Vuitton store at the bottom of like the Palace, in the basement of the Palace Hotel. But obviously, he has ridden and been aggressive in exploiting the rise of China and China joining and not just China, but lots of countries in the Middle East and in Asia joining the global economy, the concurrent rise of an affluent class, and then the psychological need. It's so interesting of people who are newly rich to feel like they're a part of, that they're distinct from their fellow countrymen. They're part of a global affluent class, that they feel special.
Right.
And he's just tapped into that need and sold a lot of handbags.
I thought that was interesting too, that you got into, like, he understood the power of luxury logos in particular, right? And really understood that, kind of gave a marking to somebody who maybe was successful, but by having that logo kind of just cemented that position.
I think there was at one point in the company's history where they were arguing that the Louis Vuitton monogram had ceased to be relevant. Mm-hmm. And you fast forward today, I visited Paris for the story, and next to the Louis Vuitton flagship on the Champs-Élysées is a new structure that they're renovating. We don't know what it's going to be yet. And they've covered it in a sort of monogrammed facade. So it looks like a big Louis Vuitton trunk. And the number of tourists who flock to basically a building under construction to take pictures talks to the global resonance of these marks. And you couple that with the way in which he has exploited celebrity, Pharrell Williams at Louis Vuitton, Jay-Z and Beyonce at Tiffany, go down the list. Rihanna started her own brand inside LVMH. And the way, celebrities flock to their shows, there's a reciprocal relationship, the celebrities posting on their Instagram, bathing in this aura of opulence that Arnault has created. It is about, yes, it's about the marks and the monograms. It's also about celebrity and a lifestyle that people aspire to.
He understands that. He understands social media. He's not on social media, though, right?
It's funny, all the kids are, and
he's got,
except
5?
for Delphine, the oldest daughter's not. The 4 other kids are, and Antoine, the oldest son, said, he's on it, and he monitors, but he's not posting. And they tried to get him on Twitter at one point before it was X, and he was apparently reluctant.
So you met him. Tell us about the meeting and meeting him for the first time.
Well, this might surprise you, but he was better dressed than I was. It's exquisite, right? I mean, the way he holds himself, the way he dresses, to me, he was very French. I was probably very American, but he was generous enough to do the interview in French. My colleague Angelina Rasquet and I interviewed him, and just extraordinarily patient. I got the sense that he enjoys talking about, like, we were not there to press him on succession, on what the next company he's going to buy. I mean, we break some interesting news about that in the story, but we really wanted to know, tell us, share your stories. Tell us how you built this business, how you think about operating 75 disparate houses together. What are the synergies? What was it like, visiting China recently, where in contrast to the first visit, throngs of people are out to see him and asking him to bless their babies. And so, I feel like he got into it and had a good time with us. And then just sat for this extraordinary photo shoot with Reuven Affendor.
It's gorgeous.
And which, makes for a really beautiful inaugural issue of the monthly Businessweek.
Okay, we'll talk about the succession element to this in a few minutes, but before we get there, I just want to learn a little more about his empire, the real estate portion of this, because yes, he's known for these luxury brands, these luxury houses, but it's also a real estate company.
That's right. And another one of our colleagues, Natalie Wong, on the real estate desk here at Bloomberg News, really helped us with this. I would say it probably started more modestly a decade or two ago, buying real estate in Midtown Manhattan, on Rodeo Drive in LA. LVMH has a separate arm, sort of an investment arm, L. Catherton. They did a lot of deals through that. And over the time, it's gotten more and more aggressive, where they're now designing whole new shopping districts in cities like Miami, in Montreal, where a whole new luxury district is underway with LVMH as the primary backer, in Asia. And it just gives, well, first of all, Arnault a number of ways to win, not just on the sales, not just on the rent to rival companies who take store space, but on the underlying appreciation of the asset. Right. It's an extraordinary amount of power, because, we talk to rivals who say, if you're in the prime spot and LVMH wants it, maybe they're the landlord and you say goodbye because they're going to take the space from you, or the landlord is so intimidated by LVMH and its power that they force you to leave. And then we asked Arnault, like, do you have too much power? And, his response is hilarious. It's along the lines of, well, if they're complaining, they're not very well managed. So he's got no sympathy. But this is a company, we talk about the advantages of the tech platforms and the power that they have to cast winners and losers. And I thought with this story, I was writing about the opposite. A figure in a company that has amassed business power in another way. But I think it's sort of the same. I think the real estate is the platform, and they own the platform, and they pick winners and losers and can anoint themselves by giving themselves the primary location, perhaps, discounts on rent, or it's just like the muscle to go and say, the corner of Fifth Avenue and 57th is the luxury capital of the world. They own 3 of the 4 corners now.
It's pretty amazing. It's pretty well. So you talk about that power, right, in terms of this, boutique of brands, if you will. And I just wonder if regulators, though, think, okay, is there too much power? Is that a risk at all as he continues to buy more and more brands?
I don't think so. There's we highlight some deals that are now being looked at in the U.S. They're not LVMH deals, right, but different sectors of luxury. But it's a different set of regulators. There might soon be a different government in France. I probably don't know enough. I mean, I would sort of speculate that they would face more problems from a leftist government than a rightist. Right. And that does seem the direction that France is drifting in now. But one of the nice tantalizing tidbits at the end of our story is that he has acquired a personal stake in Richemont, which is the owner of Cartier and some other brands. And he says he wants to maintain its independence, but this is how it starts with him, how he went after Hermes, and Gucci famously, that, he is not, even though he's 75 years old, done with his empire building.
The wolf in cashmere is how some
Love
inside
that.
luxury circles have referred to him. You write about him laying off thousands of people after acquisitions. What's his reputation within the industry?
Yeah, I would say, well, first of all, the layoffs, that was early on when, he was acquiring some of these brands as part of, like Dior, larger companies with a lot of inefficiencies and paring down to just the luxury assets. The wolf in cashmere was a phrase started by, I think, folks at Gucci and then later at Hermes, and the way in which he uses leverage buyout techniques to go acquire assets. I think he's viewed as a intimidating figure who brings pretty ruthless takeover tactics and business tactics to the world of luxury. But I think there's also a lot of admiration and respect for what he has achieved. I think at one point maybe there was a colder view of him, but how can you not admire right now, and particularly now that he's been a major philanthropic force in France and he's sponsoring the Olympics. There's probably more of a halo now than there ever has been.
Just last question: what do you think people might be surprised about him in your coverage of him in the reporting that might be surprised to find out? I know we covered a lot of ground.
Look, I mean, if you're a follower of this world, there's some stuff in here that will surprise you. If you're not a follower, if you're even a sort of quasi business informed person, you might think that Bernard Arnault is married to Selma Hayek. He is not.
Exactly.
That is one of his rivals, right? And so I think, but a surprising number of people have some of those, impressions. And so, and his wife is a concert pianist, extraordinarily impressive. So to understand who he is, his 5 children who all work in the business are also accomplished, and to understand how he has built this empire and the ways in which he now leverages his power, I think, is going to surprise a lot of people.
Brad, we lied. One more question, because you mentioned the children. I promised we'd talk about succession. 5 kids. Very briefly, who should we be watching?
Yeah, I mean, all of them, right? Because they're all remarkable. Delphine, who runs Dior, is the only daughter, the oldest daughter. She is the sole descendant on the executive operating committee of LVMH. So I think you'd have to say, like, she's got, she's probably, if we're going to talk about it in a race, and I don't know that they do, she would be the natural. But the way in which his youngest, Jean and Frederic, are getting increasing authority. Alexander, who now co-runs Tiffany & Co., and then Antoine, who is a non-executive chairman of Loro Piana and runs all the image and communication for the company. They all have their pieces, and my impression, by the way, in closing, is that, like people we know well, even though Mr. Arnault is of advanced age, he has no intention of stepping back. He is in it for the long haul.
And if you're playing tennis with him, do mention that rival, because it might give you a little bit of an advantage. Anyway, read the story.
Just don't wear Nikes in the store.
Do not wear Nikes in the store. Incredible. Brad Stone, congratulations. The new launch of Bloomberg Businessweek, now a monthly. Brad, of course, the editor of Bloomberg Businessweek. Bloomberg Businessweek now on newsstands, online, and of course, always on the Bloomberg terminal.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, on the Brooklyn waterfront, sandwiched between South Williamsburg and Dumbo, bordering Fort Greene, you'll find the Brooklyn Navy Yard. Maybe you've been to Wegmans or some of the other more than 450 other businesses that operate at what for more than 150 years was a shipbuilding facility that launched ships including the USS Maine and more. Now, the Brooklyn Navy Yard wants to be a hub for the health and beauty industry for women and minority-owned businesses, and it's allocated $25 million to help achieve that goal. As you know, June is Pride Month, and all this month we're featuring here on Bloomberg Businessweek voices on topics related to equality. We've got with us Lindsay Greene, the president and CEO of the Brooklyn Navy Yard. She's here in our Bloomberg Interactive Brokers studio. Okay, before we get to this investment, Lindsay, you've got more than 450 businesses at the Navy Yard. Wow. Okay, we've got to update some numbers here. 550. They employ more than 11,000 people. Is that right?
Correct.
Okay.
That's correct.
According to your team, they generate more than $2.5 billion per year in economic impact for the city. You've got a good view of the health of the economy of the city. How's it doing? How's New York City doing? How's Brooklyn doing?
Brooklyn's great. I mean, if you ask Borough President Antonio Reynoso and before him, the mayor, Brooklyn's been great for decades. It's a really valuable brand, and it's a really valuable its own ecosystem. It might rival Silicon Valley at this point as a place of innovation.
Well, walk us through, we were talking in the newsroom that Brooklyn Navy Yard, a lot of us know. You live in Brooklyn.
Yeah.
You know it really well.
I ride on that bike path right by the Brooklyn Navy Yard all the time, the Greenway.
As do I. I bike to work.
See, but we're a global audience, right? And we're a national audience. So tell everybody about kind of what that development was and where it is today.
So at its peak, the Navy had 75,000 people working at the Navy Yard, and it was really a center of innovation and inclusivity for the Navy. They had their first diesel ships, their first, some of them, the submariner safety systems were built there, and we've carried that through. And so you have companies that are based at the yard that are really at the frontier of their field, whatever it is. We still have a functioning shipyard. It's a second generation Hispanic owned business, which is amazing. Shout out to Alex Gomez. And we've got people doing robotic arms for the Mars rover. Somebody else trying to make consistently fermented bacteria for kombucha. I'm a kombucha drinker, so I like that stat. People making bedazzled denim jackets, other folks making body armor for special forces. It really is a range of businesses, and one of the best signals I can point to of the health of our economy in particular is that we had about over 1.5 million square feet kind of come online at the Navy Yard in 2019 and 2018, and all of that space was basically fully leased up through the pandemic.
One of the things that is known by everybody about New York City is it's incredibly expensive. So oftentimes you don't see a lot of industry happening here that's new, right? You have the established industrial areas like Gowanus and some other parts of the city that are sort of zoned for that right now and going through rezoning. But how do you provide a space that's affordable while not giving up on other types of income?
Well, I think first and foremost, it matters that we're a city-owned property, right? The Navy Yard, basically, when it was decommissioned in the 60s, was given over to the city. It took the city decades for a whole host of challenges we all know about, fiscal crisis, et cetera, to really reinvest in the Navy Yard and get that employment back up into the thousands. But we start with being a city-owned asset, and so our job is to be a place of economic opportunity and growth. And so in that regard, we effectively get subsidy from the city. And we pass that on to our tenants in the form of just how we structure the leases and the fact that we make a lot of the capital improvements in the buildings. So it's always going to be a bit more affordable than private market industry. And we don't cater to some of the forces that have been driving up industrial rents in the city, which is e-commerce distribution.
It also sounds like the development was very purposeful in terms of having, like you said, diversity in terms of industry, and I'm assuming in terms of business owners. Is that fair?
Yes, 40%. Just about 40% of our business owners at the Navy Yard are either women or people of color. And that has, again, continuing the thread, the Navy employed almost 10,000 women in capacities. We had a lot of rosy riveters at the Navy Yard. And it was also a legacy, particularly for Black employment in Brooklyn for a long time. And so we maintain that in the demographics of who works there. And even as industry evolves and gets more advanced, through our employment center, through the creation of the Brooklyn STEAM Center, which is a next generation technical high school, and other things that we do, we're keeping an eye on how industry evolves and gets more technical, and making sure that our local residents in Brooklyn and the city can keep up with that.
Well, go ahead, Carol.
I am curious, though, like during the pandemic, how did the Brooklyn Navy Yard fare?
We fared really well. So a couple things happened. One is the Navy Yard was kind of the brain trust of local manufacturing work that spun up to help produce PPE and other necessary medical or just other, sanitary supplies. Yeah. Our bourbon company, bourbon distillery, made hand sanitizer. And
also probably sold a lot of bourbon.
That's what I was thinking.
And probably also still sold a lot of bourbon, but their tasting room wasn't open, right? So it became a makeshift hand sanitizer bottling station. A bunch of the companies made masks. Two of our companies, Lafayette 148 and Cry Precision, Cry makes the military special forces uniforms. They basically figured out how to reverse engineer a medical gown. And created a technical packet to be distributed across the city to other garment manufacturers and said, hey, we're all going to make a medical gown. I, at the time, was working at the Economic Development Corporation. I was helping source fabric from all over the place because it's a different type of fabric that doesn't allow germs to pass through, and helping distribute it to a lot of these manufacturers. And so The Navy Yard businesses collectively made, I think, over 10 million pieces of PPE, and that's just the handful that were involved in COVID response. And they did that because a lot of them, they've been here for a long time. Some of them are second generation businesses, and they wanted to help. And it was a way to keep their workforce going. Yeah. And then you had other businesses that were innovating and doing amazing things, businesses that were created. There's lots of stats out there about downturns in particular become opportunities for entrepreneurship, and we had a lot of businesses that came to the yard in 21 and 22 that were a handful of people and now are up to a couple dozen.
Pretty impressive.
Lindsay, is there room at the Navy Yard for expansion right now?
Yes, there is.
How much? Give us a percentage of what's been developed into what can be used for the types of businesses that you talk about versus what's left for you to do there.
So what's left is an interesting concept, actually. We are in the early stages of planning for our first new construction industrial building. Most of the last several decades, we've been putting money into the infrastructure the Navy built and making it a little more modern and suitable. We had a couple of new buildings that were built as additions to the Wegmans complex, but by and large, we had buildings that dated from World War II.
We did a story on Wegmans being in Brooklyn, just so we knew this was a big deal, but go ahead.
Yes. Some of the buildings date from the Civil War, right? And so when you look at what is needed to accommodate, high growth industry that's going to happen, that is probably going to need industrial space, all of the companies working to address climate change and coming up with that's stuff. It's a device you need to help seal up your brick building that has no insulation better, or it's a new mini split AC heating system, all that stuff. It's physical. We will have space for them. We're going to build a new building. And
do we talk? Go.
Well, before we let you go, we got to talk about this $25 million grant that's going to help achieve the goal of becoming a health and beauty industry hub for women and minority-owned businesses.
Music to my ears.
How does this work?
So if you hear stories about health and beauty entrepreneurs and wellness, they're famous for fabricating in their kitchen, right? There's the stories about somebody making a hair care product or a facial product on their stovetop, and when you sell at farmers markets or you sell at other boutiques, and you get to the point where you need to make your first several hundred, and most traditional manufacturing facilities only want you to make thousands. And so what the team at IO Labs has put together is a state-of-the-art facility that will have order quantities that are suitable to scaling entrepreneurs. You can come and ask them, can I make 300 of this? And they'll say yes. And they have a team that is staffed and equipment that they have researched and know what to install, so that they'll be able to do toothpaste or sunscreen or a crazy hair care product like I use and I use on my daughters. And so all of those things you can get in one place, in addition to all the support around connection to how do I market, how do I talk about a toothpaste on social media,
real
how do
incubator and kind of manufacturer.
Yeah, it's a combination incubator and contract manufacturing.
Very cool stuff. Thank you so much. Come back soon and let us know how it's all going.
Thank you. Thanks for having me.
Really fun. Lindsay Greene, President and CEO of the Brooklyn Navy Yard.
I wish you stopped wasting all my energy.
Okay, so we know that data centers that form the backbone of our digital lives are increasingly being tapped in the AI frenzy. We know that they use a lot of energy, but how much?
Right. Well, data centers, use more electricity than most countries. Tim, only 16 nations, including the U.S. and China, consume more.
Okay, that's just one of many kind of crazy numbers in the next story that we're going to be talking about. What's also wild is that the supply of power doesn't exist everywhere to power these data centers. So the almost overnight surge in electricity demand from data centers is now outstripping the available power supply in many parts of the world. This is according to a recent Big Take written by a Bloomberg News team that includes energy and climate disasters reporter Josh Saul. He's here in the Bloomberg Interactive Brokers
Your title
studio.
alone freaks me out, but you're welcome.
Yeah.
It's a great team. It's a great team, and thanks for having me on.
It is.
How is AI already wreaking havoc on global power systems?
Well, there's a lot of different ways, but one way I'd start is we've had an ongoing quest to purge carbon from our electric grids and build more green power, right? Like more solar and wind farms and fewer coal and gas plants. That's better for carbon emissions. That's better for climate change. And what happens when you add huge new loads, huge new power demands to the grid is it makes it a lot harder to retire those old plants. So instead of a coal plant getting shut down in Kansas, there's a big data center being built right on the grid right there. And the local utility tells its regulators, like, hey, we're not going to be able to shut down that coal plant as we expected because because we need all this power to go into these servers, to go into these chips that are powering the data and the AI that we all use kind of on a day-to-day basis.
Give us a little bit more size and scope and context around how much more power is needed to fuel all these data centers.
Okay, so we had the CEO of NextEra in recently, and this is a big clean energy developer. They're also a utility, Florida-based. We had the CEO in down the hall for an ed board. He said, a hyperscaler asked him recently, the hyperscalers are the big tech companies,
right.
the Amazon, the Google, so they come to NextEra and they say like, hey, we want to build a data center, we want it to have, these factors, we want it to be able to draw this much power, and then NextEra develops the energy for them to do that. He said that one of the hyperscalers asked them for a data center that had 5 gigawatts of demand. So a gigawatt is about...
I'm just imagining Doc Brown from the Back to the
Exactly,
Future.
just yelling gigawatt.
Doc Brown, is that
as loud as you can.
So wait, give us, for those who, what is 5 gigawatts?
So 1 gigawatt is about equal to the power generation of a nuclear reactor. So a big nuclear plant, like in The Simpsons or all over the country, that's 1 gigawatt. So this
you are
is
now my favorite person on earth, but go ahead.
Thank you.
Great
and
reference.
so 5 gigawatts is a lot, and then he's Florida-based, so he used the example. That's more energy than Miami uses. So we're talking about one data center campus, one collection of data centers, just running those electrons through to keep the data and the AI going, using that much energy.
Piece of cake, just build them. I'll have it up for you in a week.
He says it'd be a combination of solar, wind,
How do you do that?
Wind and storage. Well, he's very excited about their sites. He says they've got the best sites, and there's developers all over the place trying to build a lot of clean energy to power all these sites.
How quickly can we build all that stuff?
It's pretty hard. We've got an interconnection queue that's backed up.
What does that mean?
Right, good question. In order to hook new solar or wind onto the electric grid, you have to have approval from local regulators and the local utilities, and that takes a long time. So yeah, I'd say the wreaking havoc is sucking up all the energy. And then an interesting thing, a guy at an energy conference I was at today, an executive from one of these energy companies, he says, in the old days, which he said was like 9 to 12 months ago, before the AI surge, he said if you had a big new power demand, the problem, and if you couldn't get new generation online fast enough, the problem was just that, I guess we'll just keep some old generation online longer. He says now the problem is if you can't get it on fast enough, you can't build the thing that you want to build. So you can't build the new data center, you can't build the new EV factory. So it's actually holding up. It's holding up our industrialization, it's holding up our economy if you can't get the power, which has not been the case in this country for a very long time.
Hey, Bill Gates was on Bloomberg TV a little earlier, and he said that artificial intelligence will, quote, pay for itself when it comes to associated greenhouse gas emissions, as the tech will help push forward the energy transition. He says that AI will make data centers more efficient, helping represent a smaller share of future power demand. How do you, given what you wrote for this big take earlier this week, how do you take a comment like that?
So there are a lot of ways that AI can be, for lack of a better word, really amazing. And to take what he says in a broader sense, he's talking about AI making us more energy efficient. It's kind of everything from, your house running more energy efficient to kind of simple things like, we're not in the house, the temperature can come up a couple degrees, or maybe the dishwasher should run in the middle of the night when power is cheaper, kind of some simple things like that, to some really complex things like, your EV that's charged in your garage should take power off the grid when it's when power is cheap, and then put it back onto the grid when power is expensive. So that's pretty exciting. That's hard to do on like a whole grid scale. So AI taking over some of those kind of tasks and making our energy system better, that's what he's talking about.
And to be fair, Bill Gates is an investor in some small modular reactor companies.
That guy loves nuclear.
Yeah, he loves nuclear.
Yeah, right. We've talked about that. But wait, the power that's needed for that AI to help us become more efficient is going to use a lot of energy. Right? Do you know what I'm saying?
We have to generate a lot of power
in order to get to that place where the AI that can then help us.
Yeah, sure. Yes.
So, okay. So how do you see, I'm thinking about the grids that are already stressed that are out there, Josh. If we can't, how quickly are we going to be able to ramp up demand, whether it's solar, whether it's wind, whether it's coal? Unfortunately,
right.
As somebody
I would say, I would just
argue.
Quick fix. How fast can we ramp up generation? The demand is the thing that's coming up really quickly. And
I'm talking about generation.
How quickly do we ramp up the
supply
generation?
Side.
The supply in order to generate it. It's really hard, and it's what we've talked about some with fossil fuels staying online for longer than we would ideally like if we're trying to decarbonize.
Right.
And then lots of new generation like offshore wind, solar, and et cetera.
Josh, 30 seconds left here. Is there a chance that the U.S. can't do this quick enough and then becomes a loser when it comes to these data centers, and other countries are able to get this because they have, cheaper energy or more available energy, wind, solar, hydro, et cetera?
2 quick points, because of national security concerns and other things of that ilk. A lot of data has to remain in country. You can't have all of our medical records in some country that we don't even have that great of relations with. And then 2, the energy companies I'm talking to, from gas companies to solar developers, they are pretty excited about having a bunch of new demand, a bunch of new customers. So they are not saying, oh, we're not going to be able to do this. They're more saying like, man, we've been doing pretty good. Now we're going to be doing great.
Unbelievable. Check it out, folks. It's a deep dive into all of this. Josh, thank you so much. Josh Saul, he is Bloomberg News energy and climate disasters reporter, joining us here in studio.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.